Welcome to GRE. I'm your host, Keith Weinhold. When you reduce your taxable income, that's a zero-risk return on your investment. You'll learn how to do that today with any rental real estate that you own through what's known as a cost segregation study. Even those without a giant portfolio can save tens or hundreds of thousands of dollars. An expert guest and I break it down with real-life examples. See just how it can help you today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit getricheducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Berlin, Pennsylvania to Berlin, Germany, and across 188 nations worldwide. I'm Keith Weinhold. You're listening to Get Rich Education. And one way that I like to be positioned in real estate is the sense that I own it directly, yet I use a property manager so that I'm shielded from the day-to-day responsibility. I care, but I can still live my life. Now, you might favor direct ownership like I do, yet choose to self-manage your property instead. That's a viable way to do it. Self-management is how I started out. But however you handle the management, when you own directly, you can alter your effective post-tax rate of return on your investment. And that's what we're talking about doing today with a cost segregation. What this effectively does is increase your tax depreciation benefit. Though depreciation sounds bad as a word, in the real estate world, even without spending any of your own money, it's still classified by the tax code as an expense that you can deduct from your taxable income. You don't want to reduce your income, only the taxable income, reducing the portion that the IRS can get a piece of. Now, unless it's a condo, your rental property probably includes both a structure called the improvement and also the land. Now, your improvement has components that wear out, and even the IRS knows that the land does not wear out, yet there are items on the land that you can get this accelerated depreciation on through a cost segregation, like fencing and lighting and carports. A lot of people don't know that. So there is, therefore, a land improvement segregation, often on a 15-year schedule. But it's even more lucrative to get cost segregations applied to things inside your building or home that wear out faster, like countertops or flooring, as we'll see today, on shorter schedules like 5 or 7 years. Said another way, what you're doing is that you are shielding more of your taxable income. And I'm going to ask today's cost segregation expert guest for an example near the start of our conversation. So he'll give us some numbers, and you want to listen to that part closely, and you might find yourself skipping back to re-listen to some parts today as we give real-life examples on how a cost seg works. Now, today is a presidential inauguration day, so it's appropriate that we cover this today because Trump is widely expected to reset 100% bonus depreciation, which, as you'll see, factors into our discussion today. And frequent GRE guest Tom Wheelwright thinks that this is going to happen too, this 100% bonus depreciation. What that means that, for example, all those land improvements that I mentioned on a 15-year depreciation schedule, where you could front load it and get it all in year one of your ownership. And those components indoors on shorter depreciation schedules, like 5 to 7 years, you can get all those write-offs in year one without waiting 5 to 7 years. So that's the sweetener that 100% bonus depreciation is if Trump indeed brings that back. And you might say, wait a second, this sounds a little too good to be true. I mean, getting these amounts, you'll see they can be over $100K in tax savings, even for a small investor that you can reduce your taxable income by. Well, it is just a little too good to be true, because when you sell the property down the road, you have to pay back 25% of what you wrote off this way in what's known as a depreciation recapture tax. So it's still worth doing in a lot of cases. You would keep 75% of your benefit then, unless you do a tax-deferred exchange on your sale, and then you could defer that 25% depreciation recapture tax. So yes, today's episode is deeper than most. And being a presidential inauguration day and knowing that I like to drop a little levity here before we delve into deep topics, what does the outgoing presidential administration have to say about cost segregations?
It get hot. I got hairy legs that turn turn blonde in the sun. And the kids used to come up and reach in the pool and rub my leg down so it was straight, and then watch the hair come back up again.
I don't know what just happened there. Let me just give him another chance to clear things up. I mean, you really can do a cost segregation.
We have this notion that somehow if you're poor, you cannot do it. Poor kids are just as bright and just as talented as white kids.
Oh, gosh. Oh, dear. I don't know where to go with that. And, hey, if you're a new listener, over time, we poke a little fun at every president. We do with Trump as well. We do with Jerome Powell. No one is immune around here. Some people, hey, they might find it funny that a former real estate investor president like Trump wants to expand America's real estate portfolio by taking Canada and Greenland and the Panama Canal back too. Politics matter, but this is not a politically partisan platform in any way. What's politically partisan? It's saying that the economy is absolutely awful, but then as soon as your guy gets sworn in, 1 hour later, you're willing to call that same economy now suddenly a great economy. No, a national economy does not change in 1 hour. So free thinking and thinking for yourself beats polarizing political partisanship. That's the way it's been around here from day one. Yeah, a little levity, a good knee slapper now and then.
Knee slapper.
Coming up in future weeks on the show here, the Real Estate Guys radio show host and a friend, Robert Helms, will be here to update us on what's happening in the short-term rental market, mid-term rental market, and more. We'll also announce a big collaboration that he and I are going to do together this year, and you'll be invited to join us. Today, let's discuss cost segregation. You can take your tax burden and put a huge dent in it by accelerating your real estate depreciation deduction with a cost segregation. This can save you thousands of dollars every year or more, depending on the size of your real estate portfolio. We're talking about how to specifically do this with a cost seg expert. He's been a real estate investor for over 20 years. He builds new rentals to hold, and he and his son do that together. In fact, they're currently building a 24-unit complex now. But the reason he's here is because he started a specific cost segregation company in 2012, and he completes over 100 cost seg studies every year. So he's really the guy to talk to. Steve, welcome onto the show.
Thanks for having me. I appreciate it.
It's great to have an expert like you here. And Steve, I think a lot of real estate investors, they're familiar with tax depreciation. That's where for rental property, with residential, there's a 27.5-year schedule, and commercial has a 39-year schedule. We take the reciprocal of those numbers, and that means that, for example, in residential, you can write off about 3.6% of the improved property value every year. That's pretty nice. On a $500K property, that right there is $18K that can be sheltered from taxes annually. But most investors stop right there. So in a lot of cases, they aren't maximizing their tax benefit. You can write off substantially more than that potentially with a cost segregation. So tell us about it.
Cost segregation, as you just mentioned, you have your regular depreciation, which most do take. Believe it or not, I've come across a few people that own property for a few years and they're not taking it at all, which is, I don't understand that. Maybe they're doing it on accounting, but we get them on track with that. But as you said, 27 and a half and 39-year depreciation, whether it's residential 27 and a half, commercial 39, that's all well and good, but there's a lot of money left on the table because when you look at the piece of real estate, there's probably 22 to 32% of the asset itself, the depreciable asset, that's shorter life. For example, cabinets, flooring, light fixtures for outside, the landscaping, retaining walls, things like that that are shorter life. So what we do in a cost segregation study, we go in and we rebuild the property through an engineered study. We pull out the 5 and the 15-year property and reclassify it. And so usually you're going to wind up with about 70 to 75% of it will stay on the schedule it was on, whether it be 27 and a half or 39. But then that 20 to 30% that we're going to bring forward is a huge number. So for example, I just recently did one. It was a duplex. $510,000 was the purchase. $433,000 was the basis after land, the depreciable basis. It was kicking out about $16,000 a year in regular depreciation for the investor, which covered, their cash flow and so forth. Most people know how that works. We were able to go back and accelerate it and get them $131,000 or about 31% of it in 5 to 15-year property. So they had $131,000 depreciation amount sitting there. Then they still were able to write off the $302,000 that was left at $11,000 a year. So they're still getting their normal depreciation, a smaller number, but that $131,000, if they can use it with bonus depreciation, is $131,000 of money sitting there. They can offset $131,000 of income. That's a huge number. If they're not doing that now, they're leaving money on the table.
Gosh, $131,000 of potential tax sheltering, which is, a huge number on a $500K duplex like you described.
It's a substantial number, and if you're not doing cost segregation, then you're leaving a lot of money on the table, like I said. So then it comes down to it's cost versus benefits. So the first thing we do is I get the data from your purchase of your piece of real estate or several, whatever it is. We put together an estimate of benefit to give you an idea of what that would look like for you. Like in this example, that's what we produced was what we thought we could bring forward for this investor. And then at that point, once we determine that, you look at $131,000. The cost of our study is $1,830. So $131 versus $1,830 is a pretty good bargain, I believe. I mean, I know I'm selling my product, but that's a pretty good bargain.
Yeah.
And then the third part of it is, so we've established that it probably makes sense, but then can you use it? If you're a real estate professional, if you're familiar with what that means, you can write that off against your active and passive income. If you're not, you're a W-2 and you're not quite there yet, it may be that you don't do it now, you do it in a couple of years. But either way, the process is there when you can use it. Probably 80% of my investors are able to use it the year we do it. And if you don't use all of it, you carry it forward. So it makes sense typically to do a cost segregation study, but that's what we help you establish by one, the estimate, and two, discussing with you or with your CPA, does this fit you? Is this something you could use from a tax standpoint?
Yes, it was just a few episodes ago I described more about what real estate professional status is. The main thing is typically real estate needs to be you, the investor's principal activity. So it's not very likely that you're going to be a real estate professional if you still have a full-time day job.
There are doctors and lawyers and people like that that have a full-time job and they just could not justify spending the amount of time in being a real estate professional. But sometimes their wife would be the candidate to be that. So their wife becomes, or the husband, if the wife is the breadwinner, becomes the real estate professional. And then they can take that and write it off against their active income. And I don't want to jump into the CPA side of this. It's more of a CPA question, but that's how I understand it works. And I've seen that happen before where someone who has a full-time job is able to bring their spouse in as their real estate professional, and they're able to utilize it that way.
Well, to talk more about this benefit of $131,000 on the duplex example that you gave, if all that is able to be deducted at a 30% income tax rate, that is $40K of savings. $40K is about 30% of this $131,000 number. So that's the money, the increase in net income in your pocket.
Yeah, which is substantial. And that's where you look at your individual tax break. I'm going to save $40,000 in taxes and I'm going to spend $1,800 for the study. Makes sense to me to do that. It's a pretty good return on your money. But it comes down to being able to use it. And so that's the things that we explore when I'm talking to a client.
Now, Steve, I know in the past I have talked to cost segregation engineers and their firms on the phone where they've looked at some properties that I had, and I don't remember whether they charged me for this or not, but what I learned is it wouldn't be worth going ahead with a cost segregation study on it. I'm thinking that they didn't charge me anything to tell me that, but really what I'm getting at is, can you tell us more about when it makes sense to do a cost seg on properties and when it does not?
Well, if you're going to sell it in the next few years, it does it because you're going to recapture. So you don't want to spend money for a study only to get the benefit for a year and then sell it and have to recapture it. Now, in my personal situation, I have done that because I bought more property and I was able to use the cost segregation to offset my gains versus a 1031. So by and large, it doesn't make sense if you're going to sell it. That's number one. You may have owned it for 8 or 9 years, 10 years, maybe you've used a lot of your depreciation already. So that delta between the accelerated depreciation and what you've already taken may not be enough to make sense. It may be a property that's, $80,000. Probably doesn't make a lot of sense to spend the money. The math just doesn't typically work there. I've done some as low as that because they wanted the tax benefit, and I'll do whatever the client wants me to do. But those are the three things that I would say probably would determine whether it makes sense or not. But that's where the estimate comes in. I mean, you bring me a property, and if it's $40,000, I'll tell you before I do anything, probably not worth messing with it. You're not going to get much benefit. But if you bring me a property and it's a $125,000 asset, we'll take a look at it. I'll do a quick estimate for you, no charge, and it'll either apply and make sense for you or it won't. And I'll be the first to tell you if it doesn't. You know your individual tax situation. I'm just talking about the dollars that we create for you versus the cost. If it doesn't make sense, I'll tell you, I don't want you to waste your money doing a cost segregation study if you don't need it or can't use it.
Okay, so there are a number of factors here, which could include how long the investors own the property, how soon they plan to sell the property. It sounds like there's generally a correlation here with the larger the property, the more likely it is that it makes sense to do the study as well.
It does. I have a client that I'm working on right now. He has 6 properties, and I think they were 2021 acquisitions. So that was 4 years ago. And they're not on a depreciation schedule. He hasn't taken anything. So in this case, you certainly would want to do a cost segregation study on that. You need to have your properties on a depreciation schedule anyway. For whatever reason, they weren't there. So in this case, if you came across a client that had a property for 10 years, and for some reason it was never on a depreciation schedule, which I don't know how that would happen, but let's assume it did. In that case, it would make sense to do it because you're going to catch up all that depreciation from 10 years ago all the way through today, which would even be a larger number. So that happens occasionally. Rarely it happens, but it does happen where someone has never depreciated a property.
We're talking with a man that can greatly reduce your tax burden. I think for one thing, first, he's going to check to make sure that you're taking the basic tax depreciation. But beyond that, as you can see here, there's a potential to do a lot more with a cost segregation. You're listening to Get Rich Education. More when we come back on Cost Seg Studies. I'm your host, Keith Weinhold. Hey, you can get your mortgage loans at the same place where I get mine, at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com. Oh, geez. The national average bank account pays less than 1% on your savings, so your bank is getting rich off of you. You've got to earn way more, or else you're losing your hard-earned cash to inflation. Let the Liquidity Fund help you put your money to work with minimum risk. Your cash generates up to a 10% return and compounds year in and year out instead of earning less than 1% in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And you know how I know? Because I'm an investor in this myself. Earn 10% like me and GRE listeners are. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866.
Hey everybody, it's Robert Helms of the Real Estate Guys radio program. So glad you found Keith Weinhold and Get Rich Education. Don't quit your daydream.
Welcome back to Get Rich Education. I love talking about tax savings vehicles because it's like a no-risk instant ROI to you. That's what we're doing today when we're talking about accelerating your depreciation and reducing your tax burden through a cost segregation. And Steve, in my experience, I know that you can't just ask anyone to go do this study like your slack-jawed uncle with a tape measure and sending him out there. It takes a person with a certain credential and a cost segregation engineering analysis. So can you tell us more about what physically needs to take place to have a cost seg done?
Yeah, you're right. You could try to do this yourself, but it probably wouldn't pass muster with the IRS if they were to question the study. One thing that we do, and most firms like mine would do also, we do back up the study, and we do guarantee that we will defend the study on your behalf. If there's a question, very rarely does it come up, but if there's a question from the IRS, we step in your place and defend the study and justify how we arrived at these. And that's only through an engineered study. So if you have your uncle, as you mentioned, doing it, it doesn't follow the audit technique guide, doesn't follow the guides that are required for a cost segregation study, you're probably going to find it getting kicked out and wind up owing taxes and penalties. So you want to make sure you use someone that's qualified and they do an engineered study. Same thing as a CPA. CPAs aren't qualified to do a cost segregation study because it is an engineered study. If we're breaking down the entire property and rebuilding it with our software. On commercial buildings, you'd mentioned, what do we do? Commercial buildings, we do a physical site visit. We actually go to the property. Those are more expensive because we're there at the property and travel time and so forth to do that with engineers. On residential, we have a unique program. We do a virtual site visit where I can do this from my desktop, and that's why I'm able to keep the cost down. But we still do a site visit because there's so many tools available today to be able to do a virtual site visit. I mean, for anywhere in the United States. So we can do this anywhere in the United States. And I take the tools that we have, the data I get from the client, we can do a virtual site visit and create the study from that.
Really, what the IRS is doing, whether this probably isn't reality, but they're saying your property wears out completely in 27 and a half years. That means that you can take some portion of that and depreciate it each year. But with some of these components that you mentioned, like the flooring and like the bushes, I think even the landscaping is one of the components that you can do a cost seg on. Basically, they're saying that wears out faster.
Correct. Pretty much everything outside of the building is 15-year life. Sometimes even shorter than that, but that's how we class it as 15-year life. Like your driveway, like I said earlier, your retaining walls, grass, landscaping, fences, things like that, outdoor lighting, stuff like that. The inside the building is the 5-year property, which is your countertops, your flooring, fixtures. Think of things, I mean, a floor is going to wear out before 27 and a half years. You're going to be replacing it. You do it in your own home, typically. Well, I would never keep it for 27 and a half years. I wouldn't think in my house, but because they do wear out sooner. Tile is a little different animal. There's some debate about that, but for the most part, it's components like that we're able to reclass in the 5-year classification.
That's pretty generous. Grass wears out in 15 years.
Yeah, well, it's a 15-year. Yeah, it dies. Things change, you change landscape, things like that. So yeah, you do. Those can be classed at 15 years.
All right. We talked about the cost in terms of dollars a bit for what a cost segregation study might cost. How much time does it take from the time one is initiated?
It depends. We can typically work with your schedule. I get a lot of last minute folks that get with me in September and they need their October 15th or even this September 15th, depends on what kind of entity they have it in. And so we can turn these as quickly as you need it. Typically, if I have all the data and all the information, especially if it's a residential where I'm not having to travel. But by and large, I can turn these in less than 30 days, put that back to you. And if you need it sooner, we'll burn the midnight oil and get it done for you. That's during crunch time for between January 1st and April 15th if you file early or on time. If you file in October and you extend your taxes and the automatic extension in April, you've got to have the study done before you file your taxes. So if you wanted it for 2024, you need to have the study completed by April 15th of 2025 if you're going to file it April 15th. If you're going to file in October with the automatic extension, you need to have it completed by then. So our busy season is January through April 15th, and then probably starting July, August timeframe through October 15th. That's our busy season. So the point of it, if you're going to do a study and use it for your current tax year, it must be completed, no matter when you purchased it, but it must be completed prior to you filing your taxes so you can use it on that tax return.
All right, so we're just getting into Steve's busy season. So if you think this can benefit you, you want to initiate that sooner rather than later. But Steve, when we talk more about the benefits, we've had a change in presidential administration. So tell us more about the bonus depreciation benefit.
Yeah, bonus depreciation came out in the previous administration, before this last one, Trump's first administration, that came out of that. So anything we reclass as 5, 7, and 15-year property, it's 100% bonus. In other words, if you go back to the $131,000 I mentioned on the duplex, all of that, and between September 2017 through December 31st of 2022, you get 100% of that. It's starting in January of 2023 through the end of December of 23. It went to 80%, and the next year 60, and in 2025 it's going to be 40. But there's been an extension that was passed last in 2024 in the House to go back to the 100%. It stalled in the Senate. And we think with the new administration, we'll probably, and the new tax cuts, we'll probably see this reinstated and go back to the 100%, which is substantial. If you're getting, 60% of the 131, what is that? $78,000 roughly, something like that. And if you're getting 100%, it's a big difference. So we're hopeful that we'll see that sometime in the first quarter. And so even if you file your taxes in April and it hasn't passed yet, and you've only gotten you only get 40% bonus depreciation, you'll get that extra 60 the next year. What's happening now, though, without being reinstated, you're still getting a bigger benefit because, as I mentioned before, the 131 comes forward and you get the percentage of that. The 302 is left over in that example I used earlier. You've got your regular 27.5-year depreciation, but that 131 is still 5 and 15-year property. So you're depreciating that much faster than you would on a 27.5-year schedule. So you're still getting a benefit, just not as good as when you get 100% bonus depreciation.
Okay, and again, when you're talking about 5, 7, and 15-year property, you're talking about those component lifespans.
Correct. Well, we reclass.
That bonus depreciation benefit started out at 100% a few years ago. It's been stepping down 20% each year, and that is set to most likely refresh here sometime this year back to the full 100% bonus depreciation. And if that does indeed happen, and you, the listener, you're going to be hearing about that from your real estate investor friends and your social media feed and everything else, and you're going to maybe be feeling left out of that unless you get on top of it and take part of this. That's exactly what we're talking about doing right now. Steve, why don't you talk to us about some of those other components that are included or excluded from a cost segregation study, whether that's lighting fixtures or parking lot asphalt? Tell us more.
Exterior is the 15-year life we talked about. The parking lots, the big residential, the driveways, the landscaping, the fencing, retaining walls, bushes, the things that are going to be outside.
Okay, everything outside is 15 years.
Pretty much, yes. And then when you go inside, look at the things that you would typically change out. You're not going to change your plumbing that's in your foundation and your walls unless it breaks. You're not going to change. Your roof is also a permanent, even though you change it out, it's also a permanent part of the structure, the roof is. But the inside the house, you have or even outside, you've got your brick on the outside of your siding. That's 27.5-year property. Inside the cabinets, your countertops, flooring, your decorative light fixtures, your plumbing fixtures, things like that, glass mirrors, things like that are going to be naturally shorter life. And it's pretty easy to look in a piece of property and see what's permanent. Again, like I use the example, the foundation, the studs in the wall, the brick, the sheetrock on the wall, those things are permanent fixtures. It's the things that are movable parts typically that you could look at. And that makes up 22 to 32%. I've had to go higher, but 22 to 32 is a good range of the asset from 5-year and 15-year.
All right. So really the dividing line for cost segregation is stated as what is a permanent fixture and what is not permanent.
Yeah, probably in a general sense. Yeah, I would say that.
Well, are there any other things that one should know about a cost segregation study, whether that's myths or misunderstandings that need to be cleared up, or just anything else at all one needs to know about a cost segregation study?
A couple of things. One, the myth is that a lot of people think that it triggers audits, that you're changing your accounting or you're getting this big bonus depreciation. That's in the tax law. And so you're just taking advantage of it. Same as your regular depreciation. Putting depreciation on your schedule, on your tax return, doesn't trigger audits. I mean, that's just buying property and you're putting it on the return. Accelerated depreciation doesn't either because you do an engineered study. So part of the myth, people think that it's going to trigger an audit. It doesn't. It's a standard practice that's accepted by the IRS. And the study, the only thing that might trigger is the agent, if they're doing an audit of your taxes, they might look at the study and say, well, why did you classify this as this amount? Well, we go back through our data and our study through our software, and we could prove out how we came up with that value. And so that's what they would ask, is something like that. But it doesn't trigger an audit necessarily just because you do a study. Second thing, I've said this, I've said to all my clients, I've said it a couple times here, it's important that you can use it, that you can use the benefit. It does not do any good to go spend money for a study and get $131,000 of depreciation, like I mentioned earlier, and it just sits there. You're a W-2 income and you can't use it towards that. That far exceeds what you're making on your property. There's no point in doing that until you can use it. There are other companies out there that won't discuss that with you. They'll just tell you, let's do a cost segregation study because you get all these great benefits, but it doesn't do any good if you can't use it. Like I said, that 131 will be sitting on your depreciation schedule as bonus depreciation, but you're not able to do anything with it. If you're a high earner and you're not a real estate professional, you can't use it. So just be aware of that. If anybody brings a cost segregation study to you and they don't discuss with you how it benefits you, I'd just be aware of that. It's got to benefit you. What's the point if it doesn't?
That's a really great reminder. You want to have this done the right way with someone that knows it can benefit you and more than offset the cost of the study. Steve, maybe I should just bring up one example here of maybe a common turnkey property that a listener might buy that's not very high cost. Say that someone buys a fully rehabilitated, just $180,000 rental single-family home built in the 1970s, 2-bed, 1-bath. I'm sure there are some it depends factors, but in general, would that be a candidate for a cost segregation if that were a new purchase for an investor?
I do it all the time because it doesn't matter how old the property is. What matters is when you purchase it. That's when your start date hits, or when you sell it, it's a start date for the next person as well. So yeah, in that case, you're going to take roughly 15% for land. We go to the county website and see what they're using for land. And if they're using 6%, that's what we use, but 15% is acceptable by the IRS. So in that case, 15% is what, $27,000. So your 147, I think, would be your depreciable amount, and at 25% of that is almost $40,000 of depreciation versus an $1,800 study. And so, if you're in a 30% bracket, you're going to save $12,000 in taxes and spend $1,800 to save it. I mean, I would swap $1,800 for $12,000.
Gosh,
pretty much any time. So, yeah, it would work, but then that comes down to you individually. What do you do for a living? What's your income like? What level of income you're at, but can you use the $40,000 in accelerated depreciation? And that can be determined between a conversation with me, you, and probably your CPA. So, because they know your tax situation the best. And then I really like the CPA to be involved. It's up to the client, but I'd prefer them to be involved so they know exactly what we're doing. Some CPAs aren't that familiar with it, so we can help them with getting this on the tax schedule if they need us to, on depreciation schedule if they need us to. I really want the CPA to be involved if the client is comfortable with it because they know your tax situation the best. I can create the benefit for you. They can help you determine if you can use it.
That's a good point. I would imagine that there are some tax preparers that have never seen this on one of their clients' returns before. So that's a great help. And that was an awesome breakdown of just how things might actually look for someone that just kind of has that most basic, low-cost 180K turnkey property, Steve. Before I ask you if you have any last thoughts or anything else that the listeners should know, if you want to connect with Steve, do that in the same way that you learn about our properties and our providers at gremarketplace.com. Click in the coaching area. Your investment coach is going to help connect you with Steve, all of his resources and adjacent resources that are helpful with you. Steve, is there any last thing that someone ought to know?
I just think if you own property at all, it makes sense to get an estimate for cost segregation. It doesn't cost you anything. And then we can decide together, again, like I said, along with your CPA, here's my benefit. Can I use it? And they cost you nothing to do that. Your CPA may charge you some time, I'm not sure. But working with me to get through the estimate phase up to the benefit, what's going to look like for you, we do that for free. And so if you own any property, it makes sense to take a look at it or just have a phone conversation. Because if you call me, you tell me I make $300,000 a year, I'm an engineer, doctor, whatever it happens to be, and I work full-time, my wife works full-time, I'm probably going to tell you, you're probably not a candidate right now because it would be a great benefit, but you can't use this great benefit right now. Let's revisit it when maybe you can. So it's just worth a phone conversation, and you get me the data that I need, which is pretty simple stuff. I could put together an estimate for you, turn it around, and you decide if it makes sense for you.
Yeah, if you have that conversation with Steve and worst case scenario, you can't use it, you better believe you're going to come off being pretty well informed in knowing the next time that you can use it, perhaps on your next purchase. Well, this has been supremely helpful, Steve. A lot of people are going to benefit from it. It's been great having you here on the show to talk about cost segregation.
I appreciate you having me. Thank you very much.
Like Steve said, it's about 22 to 32% of the depreciable assets value, which is that house or building, not the land, can be deducted at an accelerated depreciation rate, faster than the 27.5-year residential or 39-year commercial depreciation rate. And Steve told me that before some investors even buy property, they will ask him how it would look with a cost segregation, and he'll run the numbers, and that way you can use it for your pro forma ROI calculation. Yeah, before you've even purchased a property. Like I said, you can't have your slack-jawed uncle do a cost seg study. Plus, your uncle isn't slack-jawed anyway. In fact, I'm the only slack-jaw you've ever known. Now, I personally plan to send Steve a copy of my depreciation schedule so he can tell me how things would look for my properties. He can do this for you just the same. There is no charge. It's best to submit everything by mid-March at the latest if you file your taxes in mid-April. So we are now in their busy season. At GRE Marketplace, that's where you do more than connect with our investment coaches and properties. There are also service providers, including Steve. Our coaches are there to help you optimize your ROI. This is a type of thing where if you think it's a good idea, you're probably not going to pick this up later if you don't move at the speed of instruction now. So if you think that it can benefit you, from gremarketplace.com, click in the coaching area, get that set up, and we'll connect you to Steve and help you with anything else that you might need in your real estate portfolio. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.